There's a quiet hum of anxiety that often accompanies the thought of starting your investment journey later in life. We hear it everywhere, don't we? The relentless march of the compounding clock, a reminder that time, seemingly, is the ultimate currency in wealth creation. The narrative is pervasive. If you weren't investing in your 20s, you've already missed the boat, destined to be a perpetual underdog in the race for financial independence. This pervasive myth suggests time in the market is the only determinant of success, a notion that can cast a long shadow of regret over many ambitious souls. But what if this narrative, while holding a kernel of truth, is fundamentally incomplete? What if the true advantage lies not just in the years we have, but in the wisdom we apply within those years? Benjamin Graham, the father of value investing, understood this deeply. He famously stated, "The investor's primary task is not to select individual securities that are likely to outperform the market, but rather to construct a portfolio that is well suited to his objectives and constraints." This principle resonates even more powerfully when we perceive time as our most significant constraint. This video isn't about lamenting lost time. It's about confronting the hidden mistakes that often trip up those who begin their wealth-building journey later. These aren't insurmountable barriers, but rather critical learning opportunities, signposts guiding us toward more intelligent wealth creation. The truth is, success in investing isn't solely dictated by the calendar. It's profoundly shaped by the quality of your decisions, the efficiency of your capital allocation, and your commitment to understanding the underlying mechanisms of value, especially when time is a more precious commodity. We are here to dissect these common pitfalls, not to dwell in regret, but to illuminate a path forward, a path of strategic action and informed conviction. One of the most insidious traps for the late starting investor is the illusion of catch-up investing. It's a seductive idea, the belief that to compensate for lost time, one must aggressively chase high-risk, high-reward opportunities. This often manifests as a frantic dive into speculative stocks, leveraged products, or anything promising a quick, dramatic surge. It's like believing you can win a marathon by sprinting the first mile and expecting to maintain that pace. The inevitable outcome, burnout, and often permanent capital loss. The higher risk equals higher reward mantra is a dangerous oversimplification, a siren song leading many onto the rocks of financial ruin. True, sustainable wealth creation isn't built on reckless speculation. It's built on consistent, calculated risk-taking, grounded within a robust framework. Behavioral finance teaches us about loss aversion. The sting of a speculative loss is far more psychologically damaging than the fleeting joy of a speculative gain, often leading to irrational decisions that further erode capital. Instead of chasing perceived shortcuts, the critical investor focuses on optimizing return per unit of risk. This requires a disciplined approach, rigorous fundamental analysis, identifying quality assets that offer a margin of safety, and a deep understanding of an investment's true volatility and its correlation within your portfolio. It's about making every dollar work intelligently, not gambling it on the next trending asset. The hidden truth here is profound. The most effective strategy to accelerate wealth isn't about taking on more risk, but about taking smarter more informed risks, and maximizing the efficiency of your capital from the moment you begin. Another common pitfall for those beginning their investment journey later in life is a dogmatic adherence to the diversify everything mantra. While diversification is undeniably a cornerstone of sound investing, a blanket approach can, paradoxically, become a drag on growth, especially when time is a more pressing concern. Spreading capital too thinly across too many assets can dilute the impact of truly exceptional opportunities, hindering the acceleration needed to catch up. Consider a skilled chef preparing a banquet with limited time. They wouldn't meticulously prepare every single side dish with equal effort. Instead, they'd focus their energy on the most impactful main courses, those that deliver the most flavor and satisfaction for the time invested. Late starters must adopt a similar mindset, prioritizing allocations that offer the highest potential for efficient, impactful growth. The notion of diversification as a set-it-and-forget-it strategy can lead to diversification, a dilution of potential returns that leaves capital spread too thin to make a significant difference. The more effective approach for the critical investor, particularly one starting later, is to implement a core satellite portfolio strategy. This involves building a robust core of diversified, stable assets that provide a solid foundation, then strategically complementing it with carefully selected satellite investments identified through deep fundamental and quantitative analysis. These satellites represent high-conviction opportunities with demonstrably higher growth potential. Understanding asset correlation becomes paramount here, ensuring that these concentrated bets enhance rather than detract from overall portfolio stability and return. The hidden truth is that strategic allocation for the late starter isn't primarily about avoiding risk. Through broad diversification, diversification, but about concentrating capital intelligently into high-conviction opportunities that offer the best risk-adjusted returns to accelerate wealth accumulation. As the clock ticks louder for the late-starting investor, two silent killers often begin to erode capital: hidden fees and behavioral drag. These aren't dramatic market crash, but a slow, insidious drain that can significantly diminish returns, especially when your compounding period is shorter. We're talking about the invisible erosion caused by high management fees, excessive trading costs, and the commissions paid to advisors. Compounding these financial leaks are behavioral biases: recency bias, the tendency to overemphasize recent market events, and the powerful pull of herding behavior, where investors follow the crowd, become amplified under the pressure of a compressed timeline. Think of it like trying to fill a leaky bucket. You pour water in quickly, hoping to reach the brim, but the persistent leaks drain it out just as fast. This leaky bucket perfectly illustrates the combined effect of hidden costs and emotional decision-making. Many financial products are, frankly, designed to benefit the seller far more than the investor, and during periods of market volatility, the urge to do something, fueled by fear or FOMO, can lead to costly mistakes that a disciplined, data-driven approach would easily avoid. Therefore, a critical step for the late starter is to meticulously scrutinize all fees. Opt for low-cost index funds or ETFs where they align with your strategy, and always understand the fee structure of any active management. Crucially, develop a predefined investment plan. This plan serves as your anchor, helping you resist emotional reactions to market swings and practice a wait-and-see approach before making reactive changes. Understanding your own cognitive biases is paramount. Recognize how they might be subtly influencing your financial decisions. The hidden truth for those starting late is that minimizing this leakage through vigilant cost control and unwavering emotional discipline is just as vital as maximizing your inflow through smart, strategic investments. A particularly dangerous allure for the late starting investor is the siren song of seemingly cheap assets. Eager to accelerate their wealth accumulation, many fall prey to the misconception that low price automatically equates to good value. This often leads them directly into the jaws of a value trap. An asset that appears cheap but is actually in terminal decline, its low price a symptom of fundamental business weakness rather than an opportunity. Consider the analogy of purchasing a broken down car simply because it's inexpensive. You might spend more on repairs and maintenance than a functional, albeit slightly more expensive, vehicle would have cost. The quality premium is precisely this understanding. It's about discerning the fundamental durability, the sustainable earning potential, and the competitive advantages of an asset, not merely its current price tag. The common misinterpretation of buy low, sell high often leads investors to acquire assets that are cheap for good reason, neglecting the core principle of value investing as articulated by Benjamin Graham: buying good businesses at a reasonable or bargain price. This necessitates a deep dive into the underlying business. What are its competitive moats? Is the management team competent and shareholder aligned? What are the long-term industry trends? The actionable insight for the critical investor is to actively seek out the quality premium. This involves identifying companies with strong, defensible competitive advantages, a history of consistent earnings, healthy balance sheets, and capable leadership. Employing both quantitative metrics like return on invested capital and debt-to-equity ratios, alongside rigorous qualitative assessment, is essential to discern true intrinsic value from mere temporary discounts. The hidden truth for late starters is that focusing on the intrinsic quality and sustainable earning power of an investment is a far more reliable and ultimately more profitable path to wealth creation than simply chasing the cheapest available price. There's a pervasive myth that once an investment portfolio is established, the work is done. This set it and forget it mentality, while appealing in its simplicity, is a critical mistake for any investor, but particularly for those starting later. Markets are not static, they evolve, economic conditions shift, and your own personal circumstances and goals will undoubtedly change over time. Neglecting this requires continuous strategic adjustments. Imagine a ship captain setting a course for a distant shore, only to then fall asleep for the entire voyage. Without course corrections to account for shifting currents, unexpected storms, or even a change in the desired destination, the ship is bound to drift far off course. Similarly, an investment portfolio requires vigilant monitoring and strategic adjustment to stay aligned with its objectives and navigate the ever-changing financial seas. While passive investing is about avoiding frequent, emotion-driven trading, it does not equate to inactive observation, periodic rebalancing of asset allocations when they drift significantly from their targets. Strategic tax loss harvesting and a regular reassessment of your overall strategy are vital components of any successful long-term plan. The actionable insight here is to implement a strategic review cadence. Schedule dedicated times, perhaps quarterly monthly or semi-annually to review your portfolio. Stay informed about significant macroeconomic trends and their potential impact, but crucially, filter this information through your established investment thesis. Avoid the temptation of knee-jerk reactions based on fleeting news cycles. The hidden truth for the critical investor, especially one beginning their journey later in life, is that effective investing is not a singular event, but a dynamic, ongoing process of continuous learning, adaptation, and strategic refinement. We've journeyed through the landscape of starting late, dissecting 5 critical mistakes that can derail even the most ambitious investor. The illusion of catch-up investing, the fallacy of flawed diversification, the silent erosion of hidden fees and behavioral drag, the law of value traps, and the danger of strategic stagnation. These aren't insurmountable barriers, but rather illuminated signposts guiding us toward a more intelligent and effective path to wealth creation. The core message, echoing through each of these points, is profound. Starting your investment journey later in life is not an inherent disadvantage if approached with intelligence, discipline, and a truly strategic mindset. The narrative that time is the sole determinant of success is a myth. While time is a factor, it is not the only factor, and certainly not the most powerful. Consider the enduring approach of Warren Buffett. While he began his investing career at a young age, his unparalleled success is not solely a product of time in the market. It is the product of sustained, rational decision-making, deep understanding, and an unwavering commitment to value. This principle of patient, intelligent action is universally applicable, regardless of one's starting gun. For the critical investor, knowledge, a well-defined strategy, and unwavering discipline are potent forces. These forces can significantly accelerate wealth accumulation, transforming perceived constraints into strategic momentum. The power lies within you. Embrace the unique challenges of your timeline not as limitations, but as catalysts for sharper focus and more decisive action. Learn from these common mistakes, not to dwell in regret, but to build a robust, data-driven investment strategy. A strategy that leverages your unique position, your hard-won insights, and your disciplined approach for sustainable wealth creation. The journey of building wealth is a marathon, yes, but with the right strategy and unwavering conviction, even a later start can lead you to the finish line with strength and security. The question now is, are you ready to refine your strategy and embrace your advantage?